Hello and welcome to our special show, State of the Economy. We have two important macro data that has just hit us. We've got the consumer inflation, the CPI inflation for January, which has come in at 4.3%, much lower than the CNBC-TV18 poll of 4.53% and definitely much lower than the December inflation of 5.22. In fact, this is a 4-month low. We have fallen from 6.2 to 5.5 to 5.2 to now 4.53. So it's a 4-month continuous fall that we are seeing in the headline inflation. The additional sweetener is that food inflation has also come in at 6% against the CNBC-TV18 poll of 6.7%. Again, this is the lowest since, I think, August that the food inflation has notched up. All positive news on the inflation front. The industrial output for December is, however, a bit of a disappointment, coming in at 3.2%. The average we got was close to 4%. The disappointment has come from consumer non-durables, which is a minus 7.6%. With that preface, let me invite our guests. Joining us now is Aditi Nair, the chief economist at ICRA, Sakshi Gupta, the economist from HDFC Bank. Also joining us is Sameer Narang, the economist from ICICI Bank, and Devang Shah, the head of fixed income at Axis Mutual Fund. Ladies and gentlemen, thank you very much indeed for joining us. Aditi, let me start with you. 4.3 is lower than your expectation, is it? Would you want to lower any of your future numbers?
Absolutely, Lata. We were penciling in about 4.6% for the CPI inflation for this month, and it has come in good 30 basis points below what we had projected. Now we are looking at a lower number of about 4% or thereabouts for February, which is very good news. Overall, for this year, it may not make a huge difference to the average. We were looking at 4.8% for FY25. Maybe there'll be a little bit of shaving off that we might have for the FY25 number. For FY26, as of now, we're going to hold on to 4.2% because there are a lot of upside risks that may pan out, particularly in terms of how the rupee moves over the next few months. So we're not going to really take a look at changing our CPI inflation forecast for FY26 right now. But this is definitely a very healthy pace of moderation in inflation that we've seen in January, and we do think it'll continue in February as well.
Okay, thanks for that. Let me come to Sameer on the same issue. Sameer, how does this square with your own expectation, 4.3? And does it want you to change your view of 2025 numbers?
No, so Lata, we were at 4.42. It came in at 4.31. Marginally lower, led by veggie prices, which accelerated more than what we thought. Going forward, next two readings are looking closer to 4.1. So for the year, the average is 4.8. Next year, we are a tad bit higher than the RBI's estimate. We are at 4.3, given the rupee weakness and the commodity prices, which surprisingly continue to go up because of tariffs. We believe the numbers could have slightly upside surprise. But as you spoke about the food inflation bit, if you just take a step back and look at what has happened over the last 3 years, it's the food inflation which is driving the overall CPI higher. And last year has been driven largely by veggie prices. In fact, since 2014 or 12, since this series is available, only once in the last 2 years have vegetable prices gone up by 15 and more than 20% this year. So it's a cumulative 35-37% increase that has happened over the last 2 years. So hopefully next year we should see a sharp moderation, which should drive overall inflation lower. So the confidence on achieving a number around 4.3 is actually pretty high.
Okay. 4.3, of course, would be very good, but 4.2 is where the Reserve Bank stands for FY26. Sakshi, can you dwell a little more on the food inflation bit itself? Veggie prices have fallen about 15.5% month on month. They usually do in the winter months, but I think importantly, pulses prices have also fallen over 1% or 2%. In January versus December. Do you think this bodes well for a longer term? I mean, food inflation remaining benign for a goodish bit?
Yeah, Lata. I mean, see the overall number, we were for headline inflation close to 4.4. So this is a tad bit lower than what we were anticipating. And you are right. Then when you look at the food basket, of course, the biggest, moderating impact is coming from vegetables. But it is positive to see that also on the pulses, cereals, front, we are seeing, the numbers coming in softer. And I think this has to do with the fact that you have seen, good summer crop. I think the winter crop is also expected to do well. And I think this overall bodes well for the supply in the market going into next year. And therefore, the food inflationary pressure that we've been kind of witnessing over the last couple of months. So that should kind of moderate. I think the only thing that we should now also start thinking about in terms of FY26, apart from the risk from rupee depreciation, etc., is to keep a close watch on core inflation, because that was something that had provided us with a lot of cushion over the last 12 months. But we are now projecting that core inflation is going to start moving up to 4% and above 4% from as early as April 2025. Of course, there's a base effect that is pushing up this number, but I think there's also now signals that manufacturers and producers might become increasingly more comfortable with passing on some of the input costs that they've been facing. So that's something that I would closely watch.
That's something we can debate with our other fellow economists here. But before I get into this discussion about how core inflation will trend, I just want to inform our viewers that it's come in at 3.7%. Core refers to the non-food, non-fuel inflation. The understanding being that that is the real inflation of the economy, because food and fuel are not always amenable to interest rates. They are more supply driven. And hence, that is the real inflation you should look at. And that's remained below 4% for the past almost 24 months. And just by way of additional information, the miscellaneous category in the CPI basket, which includes all the services sector, that's about 25% of the basket, that has grown by only 4.3%. Now, services are something you can't import. So that is the real inflation of the country, and that's at 4.3, which is also, an important consolation for a Reserve Bank looking to cut rates. I'll discuss the core in just a minute. Let me get Devang first on why his market is not celebrating. We haven't seen the yield move even an inch, a basis point, Devang. Why are you all sulking so much?
So, Lata, I think probably you're right. On the macro perspective, we are quite comfortable. So I think most of the panelists are talking about 4.2, some bit of inching of core inflation. I think the worry comes across is this a deep rate cut cycle or a shallow rate cut cycle? Because if we are all talking about the shallow rate cut cycle, largely we have seen in India, and we have picked up the 10-year bond index. You just look at the 10, 15-year chart. The bond yields in India doesn't drift below 6.5 or stay significantly below 6.5 for long. So that's been the math, and that is what every trader, every PSU bank or everyone investor is looking at currently today. And that is why we are not celebrating. In fact, if you ask me, I personally believe RBI has done a very good job. They are already focusing a lot on durable liquidity. They are continuously injecting durable liquidity through OMOs. So that's an additional demand which has been created for government bonds. But despite that, we are not seeing that rally in bonds, because I think people are just looking at more a longer term track record on 10-year GSEC. And if the rate cut cycle is shallow, the general perception is that investors would start reducing or probably not buying significantly at these levels. So that's the reason why bond markets are not happy.
Oh, okay. But what's your expectation now on April in terms of rate action from the Reserve Bank, Devang?
So our view is that we believe still that the growth number, so we just looked at RBI's projection, and they are projecting the H2 GDP. If you look at Q3 and Q4, upwards of 6.7, 6.8%. Our numbers are still looking, when we are looking at the growth trajectory, we are seeing at 6.25 or below for Q3 and Q4. With that context, we believe that the April rate cut is very much on cards, and we believe that once the GDP print gets released at the end of the month, markets should start pricing in the April rate cut, and we should start seeing the bond markets to be happy again, and we should see the rally in the bond market yields move closer to 6.5 to 660 band. So that's our view.
Okay. Well, yeah, but, one is hoping, of course, once the currency stabilizes, people will return to foreign funds will also return to the bond market. And that has been the single biggest reason why we have been able to pull the yield down well below the 7% mark to 6.8. And now when the government is an additional buyer, insurance companies have already provided a lot of support, as have pension funds. So we have at least three big buyers who have entered in the last 2 years, insurance and pension in a very big way. Then came the FPIs because of the index inclusion. And now the government simply, or rather the Reserve Bank, simply to provide liquidity. If you don't go to 6.5 now, we don't have a chance otherwise. Let's take up Devang's point on the next rate cut and shallow rate cut or steep rate cut expectations. Aditi, you go first. What do you expect?
Based on the data that we have in front of us today, I think April we will get another rate cut. Of course, there's a lot more data which will be there, for the MPC to review by the time their April policy comes around. Most important, of course, being the GDP data. And this time we'll not only get the GDP data for Q3, but we'll get a lot of revisions as well, which may help to provide a little more perspective on how consumption and investment in particular have been moving from quarter to quarter. Sometimes we do end up seeing very meaningful revisions in some of the GDP, the derived GDP, things like consumption and investment, etc. So that is something that we will be watchful for. And of course, there's so much happening globally in terms of factors that are going to affect the currency.
Aditi, 1 minute. Are you sure about the April rate cut, or do you think it hinges on, the global factors, the strength of the dollar, and how many more rate cuts are you penciling in this cycle?
So Lata, if we are looking at today's data, CPI having come down to 4.3%, and our new estimate now for February is 4%. And that's the last CPI that the MPC will have when they go into the April meeting. So if we're at 4% in February, I think the likelihood of another back-to-back rate cut is very, very high. Of course, if we have a large currency depreciation from here out, which changes the math on the outlook for the CPI, that is definitely something
Then
that
all bets
could...
are off. Of course, I take your point. Sameer, very quickly, April cut and how many cuts as of now?
So April cut probability is fairly high. In our opinion, it ideally should happen unless, you spoke on the currency volatility bit. Then we expect one more rate cut, most likely. Whether it'll happen in June or October, it all depends on growth inflation mix as well as what happens globally. Because we don't foresee global volatility dying down anytime soon, given the movement we see every Sunday or Monday morning from the US. So we believe that will keep emerging market inflows into check. Outflows ideally should continue from most of the emerging markets and currencies remain under pressure. And this is happening when gold prices and other metal prices are actually rising instead of falling when medium-term growth outlook actually deteriorates. So given that backdrop, I think there is some uncertainty around the third rate cut when it happens, but April ideally should happen.
Okay. I'll come back to you all in just a minute on the core inflation bit. Sakshi, just your call. I think we are now running 3 people saying yes for an April cut and maybe for the next one as well. You are in which camp?
I agree, Lata. I think with today's numbers, and we are tracking GDP for Q3 closer to 6.1% right now. So given the growth numbers that will come out, I think that the RBI might want to front load its rate cut cycle. So April seems very highly likely at this stage. We expect one more rate cut at this stage beyond the April cut, which could possibly come in the June or the August policy. That's so a total of 50 basis points additional.
Okay. So therefore, for the year or for the first half, Devang, where do you see the 10-year? Assuming that all 4 of you are forecasting the Reserve Bank correctly.
It is in fact most of the rally, Lata, you are right. I think you covered that also, that most of the rally in bond market should happen in this first half of the year because OMOs would be done. Large liquidity injection is done. Post the RBI dividend, you will not get any additional OMOs because RBI dividend will be a huge pie of liquidity infusion. Secondly, a large part of the rate cuts would also be done. So unless we are not of the view that growth in India is significantly going to be lower. So we believe that 6 quarters, 6 half is there for the next 2 years. With that, I think we should be seeing 50 basis total rate cut. So April rate cut, and then probably we should be on a longer pause. With all those perspectives, I think the 10-year bond yields goes closer to 6.5. If we get any new stimulus for bond markets, like we get added to Bloomberg indices or something like that, I think probably yields touch lower. Otherwise, 6.5 is where we see the 10-year bond market yields by June 2025.
Okay, that's as good as it gets. Well, very quickly, if you all can just give me your number, and if I'm surprising you with this question, then please pass it, no problem. What is the RBI dividend you're expecting? I've heard from 3.5 lakh crore to 2 lakh crore, the entire range of expectations. So where do you stand, Devang?
Upwards of 2.5 lakh crores.
Okay, Aditi?
We're on the lower side.
Okay, so that'll be lower than 2, is it? Okay.
A little lower than last year. Put it that way.
Lower than last year. Okay. I think the budget is factoring in as much as last year, which was 2.1 lakh crore. Sakshi?
I think it should be closer to 2.5 lakh crore. That is
Okay. And Sameer?
No, I think our maths also suggests around 2.2, 2.3 lakh crore. That is where.
Okay. The math is working out to 3.5 lakh crore for me, except that the Reserve Bank says they have appointed an internal committee to look into it. So probably they want to smooth it over the cycle or something is the only doubt. Otherwise, look at the amount of dollars they've sold. I mean, they've made dividend hand over fist. And that is important in this discussion because that will mean a lot of liquidity and an impact, provided, of course, it is spent immediately by the government, spent quickly as they have been spending in December and January. If they were to spend, then we have a very good bond market positivity. Now I want to come to this core sector issue. Should we do that? We'll do one thing. We'll take a very quick break and come back. We have two views on core sector. There are people who believe there is a major disinflation in place because of the US tariffs and the likely blocking of Chinese goods. That discussion when we return. Welcome back to our special show, State of the Economy. I have been speaking with economists Aditi Nair of ICRA, Sakshi Gupta of HDFC Bank, Sameer Narang of ICICI Bank, and the fixed income expert Devang Shah of Axis Mutual Fund on the just announced inflation data of January. The inflation number has come in at a very benign 4.3% compared to the CNBC-TV18 poll of over 4.5%. Food inflation has been extremely benign at 6% compared to the 6.7 poll and the previous month inflation of 8.5%. Gentlemen and ladies, thank you very much for waiting. Let's just delve a little bit on the core inflation data, which has come in at 3.7%. Aditi made the point that core inflation, which is non-food, non-fuel, really a bit of manufacturing goods and services, could rise. Now, Devang, there is a point of view that there is a disinflation likely because of, why only Chinese, Vietnamese, Korean, all those who are prevented from entering the United States at the same pace could be providing those goods slightly cheaper in the global markets. And therefore, there is a disinflation underway. You buy that?
I think we are more of the view that core inflation is significantly not seeing any significant inch up. In fact, most of the panelists also spoke about it. I think the rise which they're looking at is from the current, and you're right, more than 24 months, core inflation has been below 4%. So if it goes up to 4.1, 4.2, I think bond markets will be happy. The real rates are still very high, so 200 basis. So from our perspective, I think we are of the view that, first of all, core inflation is not inching up significantly. But even at 4 to 4.25%, I think we still see a rate cut.
Okay. But, Sameer, I'm sorry, I should be proposing this to the economists. Do you believe in this, global disinflation, keeping the core low?
No, I agree with you, Lata. Chinese PPI has been deflating for the last 2 years now, 24 months. And this should ideally continue even this year because they are exporting their excess capacity across the world, particularly for manufactured products. So that reaches India as well, and that keeps globally disinflation momentum continuing. However, a little bit of pickup in the economy and the pay commission that comes next year implies that the bottom is behind us. We should ideally expect core inflation to pick up. Even you also spoke about the manufacturing results this quarter, and you've seen a steady pickup in margins for all firms that have reported results as of now.
Okay.
So it's very clear that margins are picking up. It is being passed on to the consumer. And as input prices have gone up since December, both because of rupee depreciation as well as higher commodity prices, that is being passed on to the consumer. So you should see it, but it should not go back to a 6% level. Maybe 4.5 is the sustainable trajectory, which works well for the economy and the investment outlook.
Okay, point taken. We are, of course, swimming in uncertainties because there is also a dollar value, which Aditi and Sakshi have pointed out, which can also impact inflation, even if commodity prices otherwise fall. But I've been very unfair to the IIP number. That's come in just as 3.2%, with consumer non-durables at a minus 7.6. A bit painful. The consumer durables has done well at 8.3% over last year's 5.2. So consumer durables is still good. Capex is excellent at 10.3%. But what do you take away from this, Sakshi, in terms of growth? What's your Q3 GDP number? Because this will enter the Q3 GDP. And what's your Q4 GDP number?
Right. So, Lata, I mean, this number on IIP has come in lower than what we were estimating. We were closer to 3.9. So this is definitely weaker than that. Keeping aside the base effects, etc., that could, kind of influence IIP numbers. For Q3, we are, for IIP at an average of, I think, close to 4, which is lower than, what we saw last year for Q3, which was closer to 6%. Right. So this combined with a lot of the other indicators that we track, GDP growth for Q3 right now seems to be tracking closer, as I said earlier, closer to 6.2 for us. And for Q4, we are looking at, we are slightly optimistic at this stage. We are looking at, 6.6, 6.7. And, these two numbers combined itself kind of signal that the advance estimate for FY25, which is 6.4, I think there's a downside to that number in our opinion.
Okay. Very quickly, running out of time. So, Aditi, your any comment on the IIP number and your GDP forecast?
See, the main thing that I'm taking away from the IIP number is that the underlying trends are extremely uneven. So when we look at the use-based categories, 3 have shown a sequential uptick and 3 have shown a downtrend between November and December. And overall, even the range of growth outcomes that we have is very, very wide from the healthy number for capital goods that you mentioned down to the contraction for consumer non-durables. The other thing, both electricity and mining have improved, whereas it's manufacturing that has shown a downturn. So again, even on the sectoral basis, it's really quite uneven. Now, big divisions that may come out.
Your growth figure.
The end of this month, I'm just going to say that holding on to 6.5% each for FY25 and FY26.
Okay. Well, I think this 10.3 capex is very clearly government spend, isn't it? I mean, we saw that massive government spend in December. I don't know if it directly reflects in IIP, but it just seems to be at least concurrent, even if it is not causational. Very quickly, Sameer, just your growth number. We don't have time for more.
Of course, Q3 is at 6.3. For the year, we are at 6.3. Next year, we are at 6.5. We believe we pretty much hit the bottom on the growth. Things improve going forward.
Okay. That's good to hear because we could have another rate cut as our economists read the inflation number. Growth has been a bit disappointing at 3.2, the IIP number. But chances are that with the rate cut, with the liquidity infusion and a budget that's already given a boost to consumption, a forthcoming 8th pay commission, which might further boost consumption, perhaps growth has seen its worst. On that positive note, thank you very much, Aditi, Sakshi, Sameer and Devang. And thank you everyone for watching this special State of the Economy.